Whether it's like an investing debate or a saving or spending debate, they're not actually debating. It's people with different personalities talking over each other. And once you come to terms with that, there's not one right answer for any of this.
What's the difference between being rich and being wealthy?
Rich is when you have enough money to make your mortgage payment, make your car payment. You can pay off your credit card bill every month. Wealthy, I think, is when you have a degree of independence and autonomy. The weird thing here is that wealth is the money that you don't spend.
Let's switch gears and talk about reading and writing. How do you select what you read?
I heard this idea, I think it was from Patrick O'Shaughnessy many years ago, who said, you want a wide funnel and a tight filter.
You're one of the best storytellers of our generation. Teach me how to tell a story like Morgan Housel.
I think it's two things. One is
I want to start with a bit of a paradox. The less money we seem to have, the more risks we're willing to take. Can you explain that to me?
Daniel Kahneman said something along the lines of, when all your options are bad, your willingness to take a risk explodes because you got nothing else to lose. And I think you see this in a lot of areas in life. One that I see it all the time in, that is a big news story in the United States. I don't know if it's the same in Canada, but in America, we spend something like $100 billion a year on lottery tickets. $100 billion. It's massive that people spend on lottery tickets. And if you dig into who's buying it, it's almost exclusively poor people. They buy the vast majority of lottery tickets. And the poorer you are, the more lottery tickets you buy. And these are some people for whom they literally can't buy food, or they might be homeless. And when whatever little money they have, they go into a 7-Eleven and buy some scratcher tickets. And you might look at that and say, like, you idiots, like, what are you doing? This is the dumbest idea I've ever seen. And maybe that's the right answer. Like, maybe you could just stop there. But in Kahneman's framework, I think it starts to make a little bit more sense. If you have someone in a situation like this, who in their mind, at least, they think, I can't get a raise, I can't build a career, I can't get promoted, I'm kind of stuck in minimum wage job. If that's their mindset, then buying a lottery ticket might be the only time in their life where they can say to themselves and believe, like, this is my literally ticket out of here. This is the only chance that I have to get ahead. And so it starts to make a little bit more sense in that situation. And maybe you contrast that with someone who has a very high net worth. They might be like, look, I could just put all my money in treasuries and just live for the rest of my life just off the interest. And when you have so much, you don't need to take the risk.
Well, it comes down to perspective, right? So like, if I could see what you see and feel what you feel, that decision would be rational.
Yeah. There's so many things in life where you can look at other people and the decisions they make, not just in money, but for politics, their health decisions, whatever it might be, and fiercely disagree with it. But what's easy to overlook is that if I were in your shoes and had experienced what you had the same family dynamic that you do, the same DNA that you do, I would do the exact same thing. And I think that is a more important question to ask yourself. Like, what financial decisions would I make differently if I were born in a different era, born to different parents, born in a different country? And I think you can't answer that question honestly because you don't know, but you know there would be a lot of things different that are completely outside of your control. Where and when you were born would have a massive impact. You and I should not pretend that if we were born in the 1960s in Nigeria, that we would have the same views about investing in the stock market over time that you and I do today. This kind of gets to the topic of luck. And a lot of people, when you bring up luck, they will say something that sounds smart that I fiercely disagree with. They say like, oh, you should increase the surface area of your luck. You should like, oh, the harder I work, the luckier I get. It was like some variation of that. And I'm like, no, if you can do something that changes your odds of an outcome, it's not luck by definition. Luck to me, the biggest are where and when you were born. You can't control it. Bill Gates couldn't control it. Elon Musk couldn't control it, but it has a massive impact on where you're going to go in life. That to me is what luck is. It's what you truly have absolutely no control over.
And then there's also the not only the country you're born into, but the socioeconomic household you're born into, the schools that you go to. How much of this is nature versus nurture versus chosen nurture?
The stat that I think is so astounding is that income among brothers is more correlated than height or weight. So basically that means if you have a brother who is rich and tall, you are more likely to also be rich than you are tall. It's more correlated than the literal DNA that you're sharing with each other. Look, is it a perfect correlation? No. Is it possible to be raised by a poor family and become rich? Of course. Is it possible to be raised by a rich family and end up in the streets? Of course. But there's a very strong correlation between those two. I think people get really can get kind of testy when you talk about luck, because if I say that you got lucky, I look jealous. And if I say that I got lucky, I feel diminished in what I'm doing in life. So it plays a massive role, but it's very easy to ignore the impact that it has in the world.
How do we break down that contribution between luck and skill, or what's repeatable on our part?
Rather than saying, what is luck? I think it's important to just say, like, what is repeatable? What is something that happened that I could do again? And if we look at Buffett, this guy standing behind our shoulder here, and let's look at the course of his life. He cannot recreate the trading conditions that existed in the 1950s that allowed him to buy blue chip stocks at 3 times earnings, whatever it was back then that he was doing. He can't recreate that. He couldn't do it again. But could I or you or anyone else listening try to recreate his patience, some of his risk framework? Like, yes. So that's something we should pay attention to. You want to find what is repeatable and what you could do again. And those are the things that you should just pay the most attention to.
I think that's fascinating, right? Because when we look at Buffett, what we want is the outcome. And what we don't think about is all the things that go into creating that outcome. So what stays the same between all these different decades where he's done this, right? Yeah. So he's done it from buying net Ben Graham stocks all the way to buying great businesses, all the way to the patience to do nothing, and then once every 10 years deploy a whole bunch of cash.
Yeah.
What is consistent across that period in your mind?
2 of the big ones, we could come up with dozens of things that are consistent with someone like Buffett, but the 2 big ones are endurance, and maybe tied to that, capping a downside risk that allows him to stick around for longer than anyone else. There's also a psychological trait of wanting to keep going longer than anyone else. I use a stat in my book that 99% of Buffett's net worth was accumulated after his 60th birthday. Like, the vast majority of people, including me and maybe you, if we became a billionaire at age 60, would be done. You'd move to Florida and buy a private island and like live happily ever after. For him to be that successful and to keep going full blast for what's now another 33 years and still going stronger than ever is a very unique characteristic that plays a massive role in his success. If Buffett had retired at age 60 or 50, like a normal person would have in that situation, you would have never heard of him. The whole reason he's so successful is just the endurance. And there's a psychological and a financial component to that. Never getting wiped out financially, and the psychology that will allow him to keep going full blast for nearly a century on end now.
But that sounds academically correct, but in temperament, incredibly difficult, because I see my friends getting rich off like Bitcoin or something. Mm-hmm. And that makes me want to change the patience that I have. I know how to get wealthy over time. We know historically that what's worked is saving money, being very patient, letting it compound decade after decade. And then all of a sudden you wake up with a ton of money and financial independence. But if I see my neighbor getting richer quicker than I am, it makes me want to accelerate that timeline.
Yeah.
And my lack of patience sort of changes the outcome.
Not having FOMO is the single most important financial skill. I think it's so important that you cannot ever imagine accumulating significant wealth over your lifetime if you are susceptible to FOMO. Like, if there's literally one thing, like one trait that you want that's going to allow you to accumulate wealth, it's the lack of FOMO. Particularly in modern markets that can get so crazy with social media and Reddit and Twitter and everything. If you are susceptible to FOMO, there's no hope for you over time. I really don't think that's an exaggeration. And that being able to see your neighbor get much richer than you and not being impacted by it is so incredibly critical and easy to overlook these days. I don't have that many financial skills. I could never be a stock picker. I could never be a trader. I don't have the intellect or the horsepower to pull that off. But I feel like I've never been at least that susceptible to FOMO. It doesn't bother me in the slightest to watch other people getting rich. Brent Beshore, our mutual good friend, had a quote that I love. He said, "I am perfectly happy watching you get very rich doing something that I would never want to do." And I think that's a great way to frame it. I don't get jealous or anxious to watch other people get richer than I am over time. My investing strategy is to own index funds for as long as I possibly can, to be average for an above average period of time. And I think that will actually lead to an incredible outcome. Not only will it achieve the financial goals that I have for my family, but I think over a long period of time, it will put you in the top decile, at least, of people who are compounding money over time.
I think that's really hard to appreciate, that what's short-term optimal and what's long-term optimal are often two different things.
Completely different things. Howard Marks talked about this investor that he knew who, in any given year, he was never in the top half versus his peers. He was never in the top 50% of other investors. And over a 20-year period, he was in like the top 4%, because everyone else who was beating him in a given year couldn't keep it going. And so, like, what's your ultimate goal? So much of investing is just define the game that you're playing. And I don't look down upon or criticize people who are short-term traders. Maybe that's their game, and for their investors or for their, like, it makes sense for them. My game is different. I think your game is different. Most people's game might be a little bit different. And what's important is that if your game is to invest for the next 20, 30, 50 years, that you're not taking your cues from people who are playing a different game of trading for the next quarter. And that's where a lot of danger in investing comes from.
You've changed my capital allocation strategy. Our conversations,
That true?
Our walks, totally. Yeah.
How so? What did you used to do that you don't anymore?
We used to do a lot more private investments, and now it's mostly index funds. And as things sort of roll in through dividends or whatever, it just gets reinvested in index funds. But it's our conversations that change that.
Well, great. That makes me happy and nervous that I'm having influence. One thing that some people will say when you talk about index funds is like, what is the guarantee that this is going to work for the next 50 years? Okay, I understand it works in the past 50 years. And my response is always like, nothing. There's no guarantee that this is going to work. It's very possible that it doesn't work out for whatever reason. And there have been periods, from the late 1920s to the 1950s where the returns were terrible. Or even from 2000 to 2010, you had basically 0% real returns in index funds. So it's not perfect in the slightest. Nothing guarantees that it's going to work or be satisfactory over time. But I think when you adjust it for the effort that is put in, the lack of effort that's put in, basically zero effort to do this, and you adjust it for the fees, which round to zero now. When you adjust for all those things, it's a very appealing way to invest over time.
If I was to look at your balance sheet, what is your capital allocation strategy?
I'm trying to think of what, like, the percentage wise, it's probably something like 15 to 20% cash, the house that I live in, and then the rest index funds and shares of Markel, where I'm on the board of directors. And that's it. Those are my only assets: cash, house, index funds, Markel stock. That's it.
Which index funds?
Vanguard Total Stock Market Index, Vanguard Value Fund, and a little bit of an international fund.
Why do index funds work so well?
Two reasons. One is it's always going to be the case that a very small number of stocks account for the majority of returns. So recently it's been FANG plus NVIDIA. If you didn't own those stocks, FANG plus NVIDIA, over the last decade, your odds of outperforming are very, very low. It's not zero, but it's incredibly hard if you didn't own those few. And even if you look at an index fund that owns 1,000 stocks, let's say, you're going to get the majority of your returns from probably fewer than 20 of them. And it's always been like that. Back in the 90s, it was AOL and Cisco and Microsoft and Dell and those kind of companies. In a previous generation, it was General Electric and Intel and those kind of companies. It's always the case that it's very tail-driven, the distribution of returns. And owning the index just guarantees that whatever is going to be the next driver, I own. Because it's extremely difficult to know what those are going to be. If you had gone back to 2004, 20 years ago, and tried to predict what are the big winners going to be over the next 20 years. Well, by the way, some of those companies didn't even exist yet. Facebook didn't even exist yet. Google was still a private company, or maybe it had just gone public in 2004. The big winners are, I think, extremely difficult to know with any foresight what it's going to be. And if you had suggested even 3 years ago that NVIDIA was going to be one of them, you would have been like, what? They make it would have sounded absurd. So you're guaranteeing that you're going to own the oddballs that account for the majority of the returns over time. The other is, I think, the lack of effort that goes into it that is needed. Investing is one of the very few endeavors in life where the harder you try, the worse you're probably going to do. And yes, there are exceptions to that. Renaissance technologies, of course, you can name the exceptions for people who tried very hard and did very well. But for the vast majority of people, there's going to be a negative correlation between the effort you put into it and the results that you got out of it. And so the leave it alone aspect of investing in index funds is very important. One little stat that I love about this is that if you look at both the Dow and the S&P 500, those are not static indexes. They change over time. There are new constituents that are added. Companies go out of business or they merge, and then new companies are added to that. If you were to look at the Dow, I think one of the studies showed over the last 100 years, if rather than adding a new company, when one of the original components went out of business or merged, if you just left it alone, don't add anything else, don't take anything out, just literally take the original components and leave them alone, you would have done better than the companies that were added and removed. Like any activity that goes into it tends to be detrimental over time. That's I've always thought is very fascinating. It's literally like there's very few exceptions in the index world to where the more effort you put into it, the better you're going to do over time.
Do you think we find it boring and that's why we don't want to do it?
It's a combination of boredom and just the counter intuition of the less effort, the better we're going to do. Because any other endeavor in life, whether it's your physical fitness or whatever it might be, there's a positive correlation. If you want to become in better shape, you exercise, you put more effort into it. In most endeavors in life, the harder you try, the better you're going to do. And investing is just not one of those. And it's so not intuitive that people end up tripping over themselves. I would also say, too, that I am not against active investing in the slightest at all. I have so much respect and admiration for the people who do it well. And the stats that get thrown around that are true, that 90% or more of mutual funds will underperform the benchmark. My response to that is always like, of course, that's how it is. You should not expect to live in a world in which everyone who tries to beat the market can do it. Of course, that's how it is. And the people who can do it are enormously talented. And I have so much respect for them. Two of them are sitting behind our shoulders here. And other people, I know people, people who have been, and I think will continue to be successful at this. So I'm not a passive zealot in the slightest. I just think for myself and many other people, it's probably the smartest way to invest.
How do you keep your goalposts from moving as you accumulate and compound wealth?
I think everyone's, including my wife's, have not stopped moving, nor should they. I don't personally aspire to live in a world where if I'm lucky enough for my net worth to go up, 100% of it just accrues to savings over time. That's not the life that I want to live. I want to have a great life with some great material possessions and travel with my kids and live well over time. If your net worth grows 10%, but your expectations grow 12%, that's when you get into trouble. It's just the gap between the two. And so, look, I'm making this up. This is not an actual analysis, but I bet over time, if my net worth has gone up by 10% per year, our goalpost has grown by 5% per year. I'm making those numbers up, but it's something like that. So yes, my family lives a better life materially today than we did 10 years ago, but we've still saved and lots of money during that period. I think that's all that matters over time is that and even Buffett and Munger, who are, known for being frugal. Buffett lives in the same house he bought when he was 26. Yes, but he also flies a private jet and had a beautiful beachfront house in Laguna Beach. These guys are not living like paupers over time. And that's what I think is really important. It's just making sure that there's a gap between your net worth and your expectations.
Seems one of the things that we inherit from society is that the house you live in is your prime financial asset.
Yeah.
That seems really recent as well, maybe the last 30, 40 years, where that's become the vast majority of wealth for Americans and Canadians.
I know in the United States, real home prices for most of modern history in the 20th century were flat as a pancake. Robert Shiller of Yale did a lot of analysis on this, tracking U.S. home prices since the 1800s. And in real terms, from probably the 1940s through the 1990s, were flat as a pancake on average across the United States. And then in the last 20 years, starting with the housing bubble that started around 2003, they exploded higher. And then, of course, we had the housing crash in 2008, and people thought that was the end of the bubble. But then they've exploded higher even more. And real home prices in the U.S., I'm sure it's the same in Canada, are much higher today than they were at the peak of the bubble in 2006 on average. Of course, there's many variables going into that. A lack of building of new homes that didn't keep up with generational growth. And it kind of bifurcates the world in terms of if you have owned a home for any period over the last 20 years, you've probably done very well. And if you are looking for your first home today, it's harder than it's ever been. Particularly now that interest rates in the US are 7 or 7.5% for 30-year fixed rate mortgage. Combine that with home prices that are just absurd, particularly in the metro areas that people want to live in. It's completely bifurcated because if you own a house for the last 10 years, you can sell that house and take the equity that has grown in that house to buy a new one to use for your down payment on the other house that's been whose price has been inflated. But if you're trying to break in for the first time, like it's a joke. It's a complete joke. So it's a very difficult thing. I have a lot of sympathy for the first time home buyer today who does not have parental support, which is the vast majority of them. It's harder than it's ever been. And there are few things that make you feel like you are stable in your adult life than owning the house that you live in. And I think it plays a huge role in a lot of things in life. A lot of people, this would have been the same for my wife and I, don't want to start having kids until they own their home. They want to have that sense of stability before they start having kids. So I think the lack of housing affordability has an impact on demographics and having kids over time that will echo for the next 50 or 70 years. So it plays a huge role in what's going on in society.
There's also sort of a difference between what's optimal financially and what's optimal psychologically. And we've had this conversation before where you've told me you paid off your mortgage.
Yep.
And that makes very little financial sense because you had one of those crazy, like really low mortgages.
Like our mortgage rate was 3.2% fixed for 30 years and we paid it off, which I say it's very true, is the worst financial decision we've ever made. But it's the best money decision we've ever made. And the difference between the two is like, look, on a spreadsheet, it's terrible. I've done the math of like, what if I had just invested that money instead? How much more money would we have today? It's a lot. It's a lot of money. But nothing that we've ever done in our financial life has, I think, given us more happiness than paying that off. And a lot of that is unique maybe to my personality. This is not advice for other people because maybe you and other people don't have that personality. I'm a worst case scenario thinker. I also have a career that can be fickle. And so, and I'm the sole breadwinner in our household. My wife is home with our kids. So with all of those, my personality, my career and whatnot, it made perfect sense. And when we did it, I was nearly in tears with joy when we did it, knowing full well that it was a dumb financial decision. So I think once you stop viewing money as just trying to make the spreadsheet happy and you view it as a tool to live a better life, a lot of things change. And in that situation, it was a tool that improved the quality of my life and my family's life, I think, dramatically, even if it was the dumbest thing that we've ever done on a spreadsheet. And a lot of people, when I say this, they'll still push back and be like, well, walk me through like why it was rational. I'm like, it's not rational. It's not rational at all. I can't explain to you on a spreadsheet. It was dumb to do, but it made me really happy. And like, is there any value to that, for you? Like, it made me happy. We could just stop right there. I don't need to prove it anymore.
But doesn't that make it rational? If you're playing a different game, right? Like if you're trying to optimize every penny over the long term, maybe that doesn't make sense.
Yeah.
But if you're optimizing for happiness and longevity, maybe it does make sense.
Yes. And so I think the qualitative factors of money are hard for people to wrap their head around, particularly in a field that has been taught as an analytical field. If you get a degree in finance or get your CFA or whatever it would be, it's purely numbers. That's not totally accurate. There's some in there, but vast majority of how they teach finance is just numbers. And so it can be hard for a lot of people to wrap their head around why you would do something where the numbers don't make sense.
What can money do for us and what can it do for us? What's the lie it tells us? What's the thing that we feel like it can do for us that it can't?
Well, I think the lie is that a lot of people in life, if they're unsatisfied with how their life is going, it's a very quick and easy answer to say, if I had more money, things would be better. And that can be true. It can solve a lot of your problems. But I think what a lot of people want in life, not everyone, I don't want to completely generalize this, but what I want that I think is reasonably common for people is I want independence and I want to spend time with the people who I love, my family and friends. And that's pretty much it. And Can you use money to do that? Of course, money is kind of the oxygen of independence. And if you can use your money to spend more time with your friends and family, you and I went out to a lovely dinner last night with each other. That cost money. Thank you for buying, by the way. And we had a great time with each other. Now, if you and I went for a walk that would have been free, it would have been great too. But using money to spend time with whom you want, when you want, for as long as you want, waking up every morning and saying, I can do whatever I want today, even if what I want to do is go to work and be productive, is absolutely critical. And that is different from the knee jerk of just, oh, if I have more money, I can buy more things, nicer things. But what you actually want in your soul is you want independence and to spend time with people who you love. Money can do those things, but it's not as direct as people think. One example of this is will having a nicer house make you happier? It might. But the reason it's going to make you happier is because it makes it easier to have friends over. It makes it more convenient to hang out with your kids in a big, nice, glorious living room. So it's not that the house will make you happier, but the house can make it more conducive to do things in your life that those things will make you happier.
I was reading Rich Dad, Poor Dad with my youngest, and we come to the concept of a house. And if I get this right, it was sort of your house is a liability and not an asset. So don't think of it as like a financial asset that's going to grow and acquire wealth for you. Think of it as a liability that's just a sort of table stakes for playing the game if you want, or living life and having stability and all these other things. And I thought it was really interesting. And as we talked about it, I was like, it's just a house. What the house is effectively, it's a container. Mm-hmm. And what matters is what happens inside that container. The house in and of itself, who cares?
Yeah. Just recently, just last month, I traveled with my son to the town that I grew up in. And I stopped by the house that I grew up in for the majority of my childhood. I hadn't been there in 20 years. We pulled in the driveway. Of course, there's people who live there now, so we just sat in the car. But I sat there for 10 minutes just kind of reminiscing about, as soon as you pull in the driveway, all these memories start flooding back of the things that happened in that house, good and bad, fun and sad, like so many memories in there from my childhood. And of course, you can go on Zillow and see what that house is worth. It'll give you a very specific dollar figure for what the house is worth. But what the house is worth to me and my parents and my siblings is invaluable. You can't put a price tag on those kind of memories. And I think that's common for most people. There's a tangible financial value and there's this intangible that you can't ever put a price on. That's true for vacations. It's true for a lot of things in life, that there's a financial value. If I asked you and said, what is this house worth? Again, you could go on Zillow and say, but what are the memories built inside that house worth? It's like, you can't put a price on that.
When you've reached financial independence, is that the ultimate, when you're spending money, but it's not a matter of the money? You're not quantifying it in sort of a dollar figure. You're quantifying it in a feeling, or...
I think there's truth to that. It's when you start using it as a tool to become happier. Now, what's going to make people happy is very different. Having an incredible Ferrari collection might make you happy. So if it's not to say that the things will make you happy are not material, that you should just use this for experiences. That I think is a step too far. I think a lot of people have hobbies that cost a lot of money that are material that really make them happy. So it's great. There are a lot of people out there who would say, who would really promote frugality and be like, you don't need a big house. You don't need a nice car. Well, big houses and nice cars make some people really happy. Other people, they don't. It's whatever you can use money as a tool for to live a better life, versus, I think, a yardstick of status and success to compare yourself against other people. That's what gets dangerous, is when you're just using it as a scorecard to compete with other people.
How do we catch ourselves in a status game where we're playing a status game, but we can't see it because we're in it?
It's unavoidable at the economy level, especially at the broad macro level. It makes sense from an evolutionary perspective that people compete with each other. There's limited resources. And if I want the food, if I want the mate, whatever it would be, I need to compete with you. That's always what it is. So it's so natural. It's never going to go away. This is truly same as ever. People are always going to be keeping up with the Joneses. And you can imagine a world in which our kids and our grandkids are living way better lives than you and I are, and living longer and have better material access than you and I do. And they're no happier for it because they're just competing with other people who have even more than that. That's always been like that. If people 100 years ago could see how you and I are living today, they would be completely dumbfounded with virtually everything we have in our life. But I would also wager that you and I are not that much happier than they are.
No.
There'd be some aspects of life we're healthier. We don't have to wake up, worry that we're going to die from the flu next week kind of. But people just adjust their expectations to whoever is around them. A lot of this is like a DNA thing. Some people are just way more susceptible to wanting to keep up with others, and other people could just care less what other people think about them. There's probably 6 people in my life who I really desperately want their love and respect. My parents, my wife, my kids, a handful of friends, and everyone else. It's not that I could care less, but after those 6 or maybe 8 people, it drops dramatically. And the vast majority of people on Twitter and whatnot, I could care less what you think about the decisions that I'm making. So I think if you define that, it's whose love and admiration do I want in life? Defining who those people are, and what do I have to do to earn their love and respect? The love and respect of my wife and my kids and my parents. And that's what I want to use money to do in my life. So like spending time with my family, taking them to cool places and whatnot. There is a financial aspect to this, but once you define that personal game you're playing, a lot of these decisions clear up.
I think a lot of people don't actually think about what game they're playing. They look at other people and, from my lens, you should be doing something different. But that really comes because we're optimizing for different things.
Yes. I bet if you and I sat down and like deeply compared our lives, there would be things that we do very differently. Spending, like you spend a lot of money on this and I don't. I spend a lot of money on this and you don't. And it's not a disagreement. It's just we're different people. Even if you and I are about the same age, same education, there's probably a lot that is just like, but we're different. So I think most financial debates, whether it's like an investing debate or a saving or spending debate, people are not actually disagreeing with each other. They're not actually debating. It's people with different personalities talking over each other. And once you come to terms with that there's not one right answer for any of this.
There's so many things that we inherit though from our parents, like invisible rules about money or practices around money. I remember like these moments in my childhood where, my parents had to decide between fixing the roof and fixing the car, and they couldn't afford to do both. And I remember they worked for the military, and the military had sent them a financial advisor. And I remember listening to the conversation they had with the financial advisor and how out of the loop they were with what was happening with my, the severance pay that my mom was getting and what was happening. And they had no knowledge of it. And I was like, I never want to be in this position.
Yeah.
What are the lessons that you learned from your parents that really stick with you today that sort of defined how you think about money?
The 2 things that stick out from my parents, my parents' upbringing. So my dad started undergraduate college when he was 30 and had 3 kids. I'm the youngest of 3. He started his undergrad when I was like a month old, something like that. And he became a doctor when I was in 3rd grade. My early childhood, my parents were very, very poor. They were students, and maybe they had some like student grants that allowed us to buy groceries and live in a tiny little apartment. We were very happy, had a great childhood, but they were very, very poor. And then my dad became a doctor when I was in 3rd grade and then it was immediate shift towards very poor to like upper middle class, literally overnight when I was in 3rd grade. And my brother and sister were teenagers at that point. So I got to see both sides of the spectrum. And I remember the year 1993 is the year everything changed in our family. What sticks out from that is that the frugality that was demanded of my parents when they were poor stuck with them after they started making more money. And so even after my dad became a doctor, we were very frugal. We lived a much better life than we did when we were poor, because we were living in abject poverty for most of my childhood. But after that, they had a very high savings rate. We were not spending money like my dad's coworkers were, like you would expect a normal doctor to. It was nothing close to that. I think I looked down upon my parents for that. I was like, we could be living in a nicer house. I know how much money you make. We could be living in a better house and driving a better car, but we don't, because you're cheapskates. That was my view for my teens and early 20s. My dad was an ER doctor, which is a very stressful field. It's literally people dying in front of you in your arms every day and working night shifts. And it's a very stressful field. So after about 20 years or so, he had just had enough. And well before I think he intended to retire, he more or less woke up one day and said, I'm done. It was a little more planned than that, but that was close to it. And because he had saved so much, he could do that. He had the independence to wake up one day and say, I'm going to do, I'm proud of what I did, but I'm going to go do something else now. And a lot of his peers could not do that because they spent like doctors. They lived in big houses and sent their kids to private school and drove fancy cars. So when they wanted to quit, they couldn't. They wanted to retire. They were tired and they wanted to quit, but they couldn't do it. And that was such a profound shift in my thinking. This was not that long ago. I don't know, 12 years ago or so, of when I was like, oh, that's why you were saving so much. It wasn't because you were cheapskates. It's because you were wanting to become independent. And now you are. You want to quit so you could quit. That's why you were saving. That was a profound shift for me of like, you're not saving because you're just scared to spend. You're saving because you want something different, which is independence. And independence is going to give you so much more pleasure than the big house ever would. That really stuck with me.
How did they talk to you when you said, hey, you're just being cheapskates, like, let's do this thing, or let's get this bigger house? Or
if they heard what I just said, they would say, yes, in hindsight, that's all true, but we didn't know we were saving for independence. They also, my parents are very interesting that they have dollar cost averaged into Vanguard index funds for more than 40 years and never sold anything ever. So they would be like literally in the top probably 2% of investors during that period without any financial education, no financial skill, like no, nothing like that. So I think a lot of the decisions they've made have worked out well, but it hasn't really been conscious. So I think back when I said you're cheapskates, I'm sure they just kind of shrugged and, you know, okay, well, this is what we're doing. But I don't think they actually had a plan for what they were doing. It was just, again, the frugality that was demanded of them. My parents also met on a hippie commune in the 1970s. Not exactly the breeding ground for like good saving skills. And so for their entire adult lives, for literally decades, they had zero money. They had absolutely nothing. So they learned how to be poor. And they were also very happy and have a great marriage. If you can learn how to be poor with dignity, that skill will just like stick with you forever. So when they started making money, I think it's probably true that they didn't exactly know what to do with it because they were so used to being poor. But whether it was conscious or not, it created this thing that has given them so much happiness and pleasure, which is independence.
what's the difference between being rich and being wealthy?
The definitions are my own, so I'm just making this up. But I think rich is when you have enough money to make your mortgage payment, make your car payment. You can pay off your credit card bill every month. Like you can afford the things that you're buying, technically. Wealthy, I think, is when you have a degree of independence and autonomy. The weird thing here is that wealth is the money that you don't spend. That's what wealth is, like the homes you didn't buy and the car you didn't buy. It's money that you saved and invested that is going to give you independence. And that's a hard thing for people, I think, to wrap their head around, that wealth is what you don't see. Because I can see your house, I can see your car, I can see your clothes, but I have no idea what your net worth is. I can't see your brokerage account. I can't see your bank account. So wealth is always hidden. And it throws a lot of people for a loop, because if I was looking for a role model of physical fitness, I can see your fitness. I can see your weight and your muscle tone and whatnot. It's all visible. But when you're looking for a financial role model, who do you look up to? And a lot of people, particularly young people, will look up to the guy in the mansion with the Ferrari. But that guy, for all you know, is living paycheck to paycheck. A lot of those people are. And the person who is actually wealthy and independent might be the person in the modest house driving the modest car that you would actually want to be. If you want to be wealthy instead of just rich, you want to be independent instead of just making your monthly payments, the people that you actually want to look up to are some of the hardest people to identify in society.
Who do you look up to?
In general, who I look up to are people who do whatever they want and people with independence. And there's a huge range of that. I think there are people whose net worth is, in the low six figures who are independent. Mm-hmm. There's a guy named Mr. Money Mustache who kind of started the FIRE movement, 10 or 15 years ago. And his story was when his net worth was $600,000, not that much money, he retired and lived a great life on it. And there's other people, obviously Jeff Bezos and Elon Musk are independent, but I would venture that more than half of Elon Musk's day is doing things that he doesn't want to do. It's like it's piling on all these things that he's still driven to do them and get them done. And of course he could quit tomorrow. But doing things that he doesn't necessarily want to do. So anyone who can wake up every day and say, like, I can do whatever I want today. If you have independence, that's my personal goal. So the people who have that at any income level are the ones I look up to.
Why are so many people who have money? I think the answer is sort of maybe embedded in the last one, but why are so many people who actually have a lot of objective wealth or money, if you will, unhappy?
Andrew Wilkinson, our friend, had a saying where he says, like, a lot of people, I'm paraphrasing him, but a lot of people who are very successful are just walking anxiety disorders harnessed for productivity.
Mm-hmm.
And I think it was Patrick O'Shaughnessy who said the single word that he would use to describe a lot of very successful people is not driven, it's not passionate, it's tortured. They wake up every morning tortured about like, I'm trying to solve this problem. I have to get ahead. I have to hit this goal. And they are literally, they wake up very anxious and depressed and like, just tortured about achieving their things. Elon Musk a couple months ago gave an interview where he said, you might think you want to be me, as in like the richest person in the world, richest person in history, but you don't. And he was like, I think he said something like, it's a tornado up here. It's a mess inside of this head. You do not want to be inside of this head. I think that's really true. I think that's a profound truth that you might think you want that kind of life, but there is a cost to that life. And the reason he's successful is because he's probably woken up tortured for his entire adult life trying to solve these problems. I am so glad and grateful that people like himself exist because they made the world a better place with new technologies that we can all benefit from. But there's a big difference between saying, I'm glad you exist and I would want your life. Those are two very different things.